Hi, everyone. I'm super excited to welcome the CEO and managing partner of a B2B SaaS focused accelerator and fund with location in San Francisco, New York, and Toronto. Prior to this, he worked in Box and Academics Direct. He's also a very well-known angel investor and invested in dozens of SaaS companies and also had invested in seed round of Flexport. I'm super excited to welcome him today on SheVC. Welcome to SheVC. I'm your founder and host, Gayatri Sarkar. So today we have Michael Cardamone, CEO and managing partner of Acceleprise, Accelerator and Fund. So Michael, I'm personally excited because, I'm a partner at Hype and we run one of the world's largest sports accelerators. So this is my pleasure to have you on SheVC.
Well, thank you for having me. Really excited to be here.
Yeah. So Michael, you have been part of the B2B SaaS industry for such a long time. So I would definitely pick on your journey, your experience, but how has your experience founding a B2B SaaS focused accelerator program prepared you in the venture investing?
I'll start with just a bit more on kind of my background to give some context, and then I'll answer your question more directly. But basically, I moved out to San Francisco in 2008 because I wanted to get into tech and was pretty naive to the opportunities. Just wanted to be part of something that had a big vision and wanted to change the world. Like that whole kind of mantra, I bought in and just really wanted to move out to Silicon Valley and be a part of it. And frankly, got lucky and ended up at Box when it was 25 people, which was my kind of first talk to that shift from like on-prem, like SharePoint to a cloud-based file storage and management system.
You could start now.
Okay. So before I answer your question directly, I'll talk a little bit more about my background to give some context on kind of my journey into SaaS. So in 2008, I was moving from New York to San Francisco, and I just wanted to get into the tech industry. I ended up.
Unfortunately, it's again. You can start.
Yeah. Okay, so just answering that one question, the first question.
Yeah, you can start. Like I can ask you again, just the question so that you know what is the question was.
Go.
How your experience founding a B2B SaaS focused accelerator has prepared you in the venture investing, and you can start saying whenever you're ready.
Okay. Great. So before I even answer your question more directly, I'll give you some context and background on myself because it will help kind of go into the story and background of Acceleprise and what I've learned through that. But basically, I'm originally from New York, moved out to San Francisco in 2008. Just was, really wanted to get into tech. I wanted to be part of something that had really big growth potential. Wanted to change the world. Like I bought into that whole kind of Silicon Valley mantra and decided to move out and look for a job. And frankly, got pretty lucky and ended up at Box when it was about 25 people. And so that was my first kind of foray into the early stages of the shift from kind of on-premise, kind of antiquated software to cloud software. And so we were going up against kind of, SharePoint, and, we were this new player building on the cloud. Like there was a lot of education around, why the cloud and why it was beneficial. And like, just the whole idea of that was so new even then in 2008. And so as part of that, I ended up going to another company that was an ed tech kind of software company that grew to about 20 million plus in revenue. And then in 2014, I still just felt like we were really in the early innings of this shift from on-prem to cloud, and felt like there was just such an opportunity to kind of help build and invest in the next generation of SaaS companies. And so I really wanted to kind of figure out a way to do that. And so I was dabbling in a little bit of angel investing. I was advising and consulting. And just the more I spent time with like other angel investors and venture funds, and I got fixated on this idea that there were all these generalist accelerators like YC and Techstars and 500, but what if there was one focused on B2B SaaS? And what if I could pull in people who had been successful in that first wave of SaaS companies like Salesforce and Gainsight and Zuora and Marketo, and pull in enough, and Box and Dropbox, and pull in enough people to kind of buy into that concept. Like, could we then build value and help be a part of building the next generation of great SaaS companies? And so started socializing it with people in my network, was very fortunate enough to kind of get a few people to buy in early, and was able to kind of pull together a small fund to kind of prove the concept. And like, make no mistake, it was a grind and took forever and was a lot of work. And in hindsight, like, way earlier than people should have been investing in me, because I had very little investing experience at the time. But now fast forward 6 years, we're now on our third accelerator fund. We're a team of, I think, 9 full-time now, plus more contractors. We've had 150 plus companies go through the program. They've gone on to raise, like, I don't know, 240 million plus and counting pretty quickly, and follow on funding from a bunch of brand name funds. And so, it's working pretty well. And we're continuing to kind of double down on what we're doing, continuing to grow the platform, investing at different stages. And so it's been a fun journey. And to answer your question around, like, how has that prepared me to be a better investor today than I was 6 years ago? I think when you look at the venture asset class and venture capital in general, like, one of the really hard things about it is it takes, it can take 6, 7, 8 years to figure out if you're any good at it. And you just don't have a lot of data points, because you make, a traditional venture investor will make maybe 5, 10 investments a year. And so, having 150 companies that we've seen from the very early stages, and seeing so many of them then raise seed rounds, and some raise Series A and Series B, we've just had a lot of data points to learn from. And so I would like to think, as someone who aspires to be a great investor, that, like, having a lot of data points to learn from and being, like, maniacal about, like, capturing learnings from those experiences, that I've gotten better as an investor over time, and certainly still learning a lot all the time, and still ways to go to be great. But yeah, I have been fortunate enough to kind of learn a lot throughout this experience.
I love that answer. And, as I was saying, that we run the world's largest sports accelerator. Now, there's so many accelerators that are going on in the world. Do you think there's a rise of accelerator fund? And what is the future of super early stage investing?
Yeah, I mean, it's an interesting time right now. Like, you hear a lot about rolling funds. There's more and more angels. And I think the way we think about it is, like, in markets like San Francisco, I think there are so many options for early stage companies that, like, an accelerator, it can be an expensive form of capital, and therefore, like, isn't going to be the right fit for everyone.
Yeah.
But what I think is happening is, like, increasingly great companies are going to be built everywhere, and the distribution of where companies are built is happening a lot faster than the distribution of where capital and angels and mentors and access is. And I think that will catch up eventually, but I think it means there's just a big opportunity for accelerators who can truly add value, be hands-on to help first-time founders with connecting into networks of investors and customers, and a community of other founders that they can learn from and, like, avoid mistakes with. And so I think there's going to be an opportunity, or there continues to be an opportunity, to provide that value to first-time founders all over the world, who want to get access to the communities and networks that an accelerator can provide. What I think is going to happen, though, is, like, there are some I think the amount of value accelerators drive for companies can vary, right? And so I think, you're just going to see some accelerators that aren't, like, truly adding value, is going to become increasingly harder. But I think if you're a good accelerator adding a ton of value, and you have founders who will vouch for that, I think there's still a great opportunity.
Yeah, I totally agree. I think the accelerator model has to change a lot. And that's what we're doing every year. We are basically, we call it remodeling, how we can add value to the super early stage companies. And obviously we have a separate fund. But let's talk about LPs, whether you're running an accelerator or you're running a fund, LPs are such an important ingredient when it comes to fundraising. So you have attracted some amazing LPs who are founders in some of the top performing companies. So what is your secret to attract such great LPs?
Yeah, it's a good question. So it's definitely a long game. And it starts, so the first 3 people to commit to in 2014, when I was socializing this idea and like had no business doing it, like very little investing experience. Like there were plenty of other accelerators, not B2B SaaS focused accelerators, but there were a lot of other accelerators out there. I had a lot of people tell me like, you don't need to start another accelerator. But I went to my boss at Box, who was the 7th person there. She was there through the IPO, like first executive hire at the company, Karen Page. And she was willing to invest in me before she probably should have, frankly. And then I went to a friend of mine who was early at Box, Anthony Kanata, who's now the CMO at Front. He was the CMO at Gainsight for a long time. And I was like, hey, he couldn't invest at the time, but I was like, who do you know? Who's one person in your network that you think I should get involved? Who's like amazing? And he immediately said Nick, who's the CEO of Gainsight. And he introduced us and put in a really good word. And Nick ended up coming in. And then Nick, then I started talking to Nick and I was like, who's the one person you think we need? And he was like, well, we need someone from big enterprise. And so he introduced me to Rowan Trollope, who at the time was a top exec at Cisco. He's now the CEO of Five9, which is a public SaaS company that I think is up 200% since Rowan took over as CEO like a year and a half ago. He's just an amazing leader. Anyway, so those were the first 3 people to commit. And so when I look back at like why that happened, I think part of it was just I impressed Karen enough with my time working for her at Box that like she was willing to take a bet on me early. And I impressed Anthony enough that he was willing to like, put his neck out there to like really push that Nick get involved. And so I think part of it was just like throughout your career, like I wasn't necessarily planning on that, but like really working hard to impress people in what you're doing, find ways to help people, even if it's outside of the scope of what your role is, like connect dots. Like I think it just, that was a big part of it. And then it snowballed from there. So like, as I executed well and like, worked hard and built trust and communicated clearly and consistently and did what I said I was going to do when I said I was going to do it, like then they felt comfortable introducing me to more people in their network. And we were able to pull in, like Teen from the CEO of Zuora and Anthony now is the CMO of Front and, the CEO of like one of the fastest growing public SaaS companies that don't disclose yet, but yeah, we were able to, it kind of snowballed from there because I was able to build trust and execute well with the first set of investors who believed in me kind of before they should have.
Yeah, I totally agree. And I know I want to go a little bit off the script. I want to ask you, there are various resilience points. Like, what are the tips that you have for people who are out there raising money for their first time funds?
Yeah, it's hard. I mean, I think it's really just understanding who are the people who are the right types of investors to invest in your fund and why would they invest in your fund? Like what is the motivation to invest in your fund? Like if I look at some of the investors in a fund, like some of them, it's like very clearly a financial return. And like, that's what they care about. If it's a family office that maybe is investing across asset classes and like, they really care about that. So then they're going to care a lot about like track record and, and what's been your track record as an angel investor, or can you point to other track record? Some of it, like, some of the high net worth individuals I talked to who are invested in our fund, I could 50x the check they put into my fund and it like wouldn't move the needle for their personal balance sheet. So like clearly they're not motivated by just financial return. I'm sure they care about it, but like they're motivated by other things. So just really understanding like what are they motivated by, what do they care about, and like can you deliver that for them? And so I think that's something that like I didn't fully understand when I first started fundraising, was like everyone has different motivations. And so I think really thinking about like the type of investor they are how this investment impacts them or not, and what they care about, like what would motivate them to do this investment versus all the other options they have. And so that would be one tip, or one thing I learned along the way.
Yeah, totally agree. So you got into SaaS very early and have invested in Flexport, Naturebox, and Station, and some other great companies. I would love to know your take, if you can share some of your learnings from this super early stage investments you made, and like what are the deal flows like when you're looking at them, and also what kind of due diligence you did. But these are super early stage companies, but at the same time, they were still trying to find out their product market fit and various other things. So would love to know your mindset into those investing.
Yeah. So the first and foremost, it was, we're investing so early that it's largely about the team and the market opportunity. And one thing that a lot of VCs will say, and it's frankly like one of the more frustrating things for founders, is like they say they want to invest in great founders, but like, what does that mean? Every founder who starts a company thinks they're great.
Yeah.
And it's such like a vague thing that like it just feels like this black box. So I started really thinking about like, what does that mean? And so one of the things that I think through is like, would I work for this founder? And I don't mean that in like an arrogant way of like, would I personally work for them? But it's really like, do I believe they can recruit good people and raise capital and get customers on board before they have the full feature set that those customers need, but like the customers just buy into the vision and where the product can go over time. And in order to do that, the founder needs to be really, really good at clearly and concisely talking about how their market's going to evolve over the next 5 to 10 years, where they fit into that evolving market, and most importantly, like how they win in that evolving market. And the more they can do that with clarity and conviction, and like make you feel like you can squint and kind of see into the future, and like they understand it and they know how they're going to win in that market, that's when you start really buying into like, okay, wow, this founder has gotten me excited about where the future of their market is going and how they win in that market. And if they're getting me excited, they're going to get other people excited, and like they're going to be able to recruit great people, and they're going to be able to fundraise, and all of those things help increase the success or probability of success for that company, right? So that's one thing. The other is like, we then do diligence on the market to see if like, do we believe what the founder is saying about the market, and like, can we find any other data points or other people who feel that way too, or that are indications that the market is trending in the way they're saying it's trending. And then if they have customers and revenue, which they don't always have when we invest, but if they have that, obviously we'll want to talk to customers to understand why they buy, but also looking for early signs of scalable and repeatable sales processes. And so one way we do that is just kind of gut check of like, if you brought on account executives or sales reps to come and sell this, like, realistically, could they book 4 to 5x what they cost in a year in ARR? And so we look at like, okay, if a founder is selling, like how much have they sold in what amount of time, and like, does it feel like you can sell enough at whatever contract value they're getting to be able to do that over time, and repeat that as you scale up the number of sales reps you're hiring in. And so we'll look at kind of early signs of that, which is hard at this stage because that can change, and like contract values can grow over time, because almost always early stage founders underprice their software because they just don't want to add friction in a sales process. And but yeah, those are some of the things that we look for at this stage.
No, that's great. And since you're on VC, we have to talk about diversity and inclusion. So we have been introduced by amazing Whitney. She's a partner at Acceleprise. So many VCs offer to take steps to improve the lack of representation in their industry, especially during Black Lives Matter movement. And what was your experience, and where do you think? Okay.
Sorry,
yeah.
It froze again. Yeah.
I will restart again. No problem. Thank you. I think I love that answer. And since you're on VC, we have to talk about diversity and inclusion. We have been introduced by Whitney, and she's a partner at Acceleprise. She's amazing. And many VCs offered to take steps to improve the lack of representation in their industry during the Black Lives Matter movement. So what was your experience, and where do you think is the systemic problem when it comes to funding Black founders and minority founders?
Yeah, I mean, look, it's diversity across our team and our portfolio has always been important to us, and I think the events that happened this year forced us to kind of look hard internally and realize we can and should be doing a lot more. And so, I think we were, if we looked back at our portfolio, which we obviously did, in the 155 companies or so we've invested in, we've had probably better than what the industry average is, but like clearly not good enough diversity across our portfolio. I think 22% are women founders. I think 2.5% were Latinx, 7% were Black. So we had some diversity, but like clearly need to do more. And so we looked a lot at like, okay, what can we do to do more? And we already run a very open and inclusive process, and that anyone can apply for the accelerator. But I think just being much more proactive around building relationships with more diverse communities to source more deals and get more deal flow from those communities is one step we took to kind of increase the amount of diversity we see throughout our funnel, and which we think will like naturally and organically lead to just more diversity across our portfolio. And then looking just at the team of like, how can we build out even more diversity across the team? I think we have significantly more women than men on the team, but like probably not as much diversity across races as we could have. And so, just really start to think about like, how do we do that? And I think if you look at the whole industry, I think it needs to be big changes from all the way from LPs who are funding these funds to GPs to investment teams. And I think everyone needs to kind of be a part of the change. And I think it just needs to be, more LPs, more diverse. I think investors need to be much more open to sourcing deals outside their network, because a lot of deals get done through people's networks, and that only, given the lack of diversity in the industry, that only will perpetuate the problem if everyone's sourcing from their own network. And so just people need to be more open to receiving cold inbounds and not always needing a warm introduction, and hiring more diverse candidates on investment teams. And so I think it's going to take a big effort across the industry, and we're going to do everything we can as a fund to help drive change. But yeah, it needs to be a concerted effort across the industry.
Yeah, I totally agree with you. I think that needs to be a very collective effort. So let's talk about the B2B SaaS startup valuation. We are seeing some amazing IPOs coming up and some amazing IPOs that happen. So when you're looking at the startup valuation, what are your thought process on these B2B SaaS startup performance data, and how do you analyze that during due diligence at such early stage? I know we talked about a little bit on the due diligence, but I would love to know your take, especially on the valuation side at an early stage compared to where they are right now. Did I get stuck, or were you able to hear me?
No, you got stuck. Sorry.
Okay. No worries. Yeah. I will. I'm not sure.
I feel bad that my internet.
No, I think it can be from my end also, because I have normally we have 2 people in the house. So today we have 5 people in the house because my son's birthday is coming up. So we have some,
nice.
And the size of the house sometimes becomes a problem. I will start again. So I love what you said regarding the collective effort that needs to come out from the GPs and the industry veterans and the emerging fund managers. So let's talk about B2B SaaS startup valuation and your thought process on B2B startup performance data. We did talk about a little bit on the due diligence side, but how do you analyze that during your due diligence at such an early stage when the performance data is none? So I would love to know your take, the valuations that you see at an early stage compared to the skyrocketed valuations at the IPOs and very successful upcoming IPOs that are coming.
Yeah. Yeah, I mean, obviously the public markets are loving SaaS companies right now. I think they're all just realizing they're much bigger markets than they originally thought, and so yeah, like record high kind of multiples on revenue across public SaaS companies, and the collective market cap across public SaaS companies continues to grow pretty quickly, and well outpace the kind of general market. With all that said, like it takes a long time for that to trickle down to as early stage as where we are. I think that impacts like later stage valuations more than it does early stage. And so when I look at early stage valuations, like at seed stage, for example, for SaaS companies, it's largely still driven by how much the company is raising. And how much you can raise as a company is largely driven by how much momentum you have. And momentum can come in a lot of different forms. It can be revenue and traction, but it certainly doesn't have to be. So certain profiles of people, like if you are early employees at a hot kind of we're seeing C valuations of anywhere from like kind of 6 up to 15 is the range, and it just depends on how big the market opportunity is, how seasoned the founders are, how much traction they have, like how many other investors are interested. Like there's a lot of things that kind of drive momentum, revenue being one of them, but not always one, which is a hard thing for founders to wrap their head around, because they'll see companies raise a big seed round with like no revenue, and they've got 20K a month in revenue, and they're wondering why they're struggling to raise. And so I think just making sure that it's like understanding what are the things that investors care about, and like what are ways to build momentum in your company, and then that will drive valuations. And then what I see is almost always seed rounds get done at where like 15 to kind of 25% of the company is given up in the seed round, and on average it's probably like 19 or 20%. So if you think about like a $2 million round, like that's probably going to get done between, call it, 9 and $12 million valuation, post money. So that's about where we see, and there's always exceptions, but like that's kind of the range we tend to see.
Yeah, and from startup fundraising, let's talk about VC fundraising. So most of our audiences are emerging and experienced fund managers, and VC is a very relationship-driven industry. So can you elaborate how an emerging fund manager can tap into market opportunities in a booming B2B SaaS market?
Yeah, I mean, so to your point, like relationships are so big. So I think building relationships with other emerging managers, who aren't going to take a whole round, but like will be much more collaborative and co-invest, people you can co-invest with. And there's a lot of ways to do that. You can do that more manually, reaching out and kind of building relationships and sharing deal flow and getting to know each other. But there's increasingly a lot of like communities and Slack groups and places that are kind of being formed and being built out, specifically for kind of early stage emerging managers. So I think I'm part of, I don't know, 3 or 4 or maybe 5 kind of communities and groups and Slack groups for emerging managers that are all kind of sharing deal flow and
Yeah, I think it got stuck. So you talked about, hello? You talked
Yep.
about I'm a part of the Slack channel and it got stuck. So if you can start from there again.
Yeah. So I was just saying, in addition to building relationships more manually, I think there's increasingly a lot of like communities and Slack groups that are being set up for emerging managers, or just like investors more generally. and a lot of them are sharing deal flow and sharing best practices. And so I don't know, I'm probably part of 4 or 5 of these sort of communities and groups, and starting to see a lot of deal flow through that. There's people who have set up like investor and startup matching tools. There's like I think there's 3 or 4 of those sort of things. So I think increasingly, like, it's easier and easier to tap into deal flow. I do think relationships are helpful, but especially for getting into kind of the quote unquote hot deals. But I think there's plenty of access to deal flow if you're proactive about joining a lot of these like communities and networking.
Yeah, I totally agree. Now, coming back to the LP side again, venture capital is one asset class, which is also cyclical, and we have a lock-up period for our limited partners for 15 to 20 years. So how do you approach liquidity to your incoming LPs or your existing LPs? What's your discussion and what's your take on that?
Yeah, so I've sold shares in companies in secondary markets, and it's largely been pretty inefficient to date. But I actually am a big in the fact that the secondary markets for private tech companies is going to get wildly more efficient over the next 5 years. Like Carda announced Carda X. I think there's like a lot of other people working on similar things that are just going to make it much easier for early stage funds to have optionality around when they want to get liquidity, and it's just going to become easier and easier. There's even funds that are popping up that are set up specifically to buy LP stakes from early stage from LPs that are in early stage funds. So I don't know, I think increasingly, like, if you're a fund manager raising right now, by the time you have winners in 5 or 6 or 7 years, and by the time like your LPs are starting to think about liquidity, I think there's going to be a robust and efficient secondary market, and you're going to have a decent amount of optionality around when you want to get liquidity from your winners. And I think that's going to be a big win for the venture asset class, because I think it'll it'll make it easier for people to show cash on cash returns, which is like few and far between in the venture world. A lot of funds, just because of the time horizon.
Yeah, I agree with you. I think the secondary market needs to develop. It's an asset class of its own, but it has to be much more matured and institutionalized. So coming back to venture capital, what we're discussing about identifying patterns, and yet some of the big ideas are unpredictable. And venture capital, I always say it's not a career, it's a lifestyle. You're working almost 24/7. You feel like in the weekends also you're working. And especially with COVID-19, the workplace and our living place kind of diffused together. It almost feels like we are living at our workplace. And so how do you manage this lifestyle? And with kids, and I have a 2-year-old, so I'm having a real difficulty. I'm asking this question to all the VC fund managers. And have you acquired any learning habits during COVID-19?
Yeah, you cut out right at the end. I don't know if you want to repeat some of the
I can repeat again. No worries. Yeah.
You mentioned you have a 2-year-old, and then it kind of cut out.
Okay. So since we are talking about venture capital and identifying patterns, some of the big ideas are unpredictable, and those decisions can take longer time. And I always say that venture capital it's not a career, it's almost a lifestyle. And we have to sometimes work almost 24/7. We are working in the weekends also. So how do you prepare for such a lifestyle? You have kids. I mean, I have a 2-year-old. I'm having a hard time managing. So have you acquired any new learning habits? Is it again got cut?
Yeah. Okay. You just came back. It was frozen for 30 seconds there.
1 second. Let me read you again. I'm not sure if this can be from my end also, but let me read it. So since we are talking about venture capital and identifying patterns. Some of the big ideas are unpredictable. And I always say that venture capital is all about, it's not a career, it's a lifestyle. You're working almost 24/7. You're working in the weekends also. So how do you prepare for such a lifestyle? You have kids. I mean, I have a 2-year-old, so managing him and fund, it's not easy. And have you acquired any new learning habits during COVID-19? Because that has made currently our work-life balance a little bit difficult, because it feels like almost we are living at our workplace. So would love to know your take on that.
Yeah, it's tricky. So I have 3 kids, 5 and under. So
Wow.
it's a whirlwind in our house. And I'm working from home like most kind of people in our industry. And yeah, I think it's I've had to just be very diligent about kind of blocking out time to spend with family and being present during that time, and like putting my phone away, and balancing that with like my obsession with like being a great investor and building this business and building this fund, and like always like just kind of innately curious about where markets are going and how they're evolving, and like finding companies that kind of solve the problems. And yeah, I think for me, it's just been much more diligent about managing time. So like, I'll take the kids in the morning and do breakfast with them and help get them to school, and then like, work during the day, and then we'll like put my phone away for like dinner and bath time, and like try to be as present as I can, and then get back online at night if I need to. And, when I'm like constantly looking at like, my at night, like I'll look just for fun, like I'll go through like Product Hunt if I'm killing time. Like I just am like really into, like I really enjoy it, so it doesn't feel like work to me. So I don't mind doing stuff at night, because it's like I just really like doing it. And so I've been able to balance it all, but it certainly is tricky with especially with kids and school schedules and all that kind of stuff. But yeah, been making it work.
Yeah, thanks a lot, Michael, for your time. I think I'm super excited to have you on VC, and I think the world is going to change with Accelerator VCs. We are seeing all around the world, and especially the super early stage companies almost becoming an asset class of its own.
Yeah, no, I really appreciate you having me on, and really enjoyed it.
Thank you, Michael.